Welcome to the DNB Alan, and I'll be your coordinator for today's note. This call is being recorded, and for the duration, your lines will be on listen only. However, you will have the opportunity to ask questions at the end. This can be done by pressing star 1 or if you require assistance at any time, please press star 0 and you'll be connected to an operator. I will now hand you over to your host, Rune Halland, to begin today.
Thank you very much, and very welcome to the DNB's analyst call for the fourth quarter. Present here in Oslo in Bråten, and CFO Rasmus Figenschou, Head of Personal Customer Maria Ervik Løvold, Head of Corporate Norway Marianne Vik Sætre, Head of LCI Harald Gaards, Head of DNB Carnegie Alex Opstad. Before we open up for a question, Kjerstin will give you highlights from the quarter.
Yes, everyone, just a few highlights on the backdrop with the Norwegian economy that continues to perform well in a world where uncertainty is growing. The GDP growth this year expected to be 1.5%, 1.6% next year. We continue to see low unemployment, and this is, after all, an indicator that demonstrates financial stability and health in the Norwegian economy. 2 rate cuts in 25. We believe there will be 1 before the key policy rate stabilizes around 3.75 for the remainder of the forecast period. Again, the same as lack of opportunities for businesses in Norway and also sectors that we are involved in outside of Norway, and this translates amongst that you see us delivering in the fourth quarter. But the backdrop is still positive for our business. The quarter as such, we are pleased to see that continues to grow even on the back of rate reductions that are also taking effect this quarter. 1.2% growth in NII, reflecting growth across segments, and as well as positive contributions from other interest related elements, offset by rate as well as some mixed effects on the NII segment. The real strong point in our mind is fees that grows this quarter. 2 very strong contributors is assets under management that has a strong net inflow of 20 billion in the quarter, and of course also DNB Carnegie with a sharp uptick in investment banking and equities and a high level of activity through. I would even highlight more the strengthened position across asset management and investment banking, where we have received many strengthened positions, among them the fact of being the institution that participated in the highest number of IPOs in Europe in 25, as well as the high that was raised in the market. Costs are up, reflecting high activity seasonally in the quarter, and also some one that we have talked to. And we also chose to highlight the cost development for the year, believing that this is more representative of the development. If we look at the underlying cost development, it's 2.6% for the year, slightly less than the inflation level that we have seen in Norway of 3.1%. Demonstrating that we work systematically towards delivering on the cost ambitions outlined in the Capital Markets Day. Strong capital generation in the fourth quarter, strong earnings per share up from third quarter, contributing to the basis on which our board intend to recommend a cash dividend per share of 18 kroner per share for the year 25. We also announced today an additional share buyback program, in aggregate taking this to 11% of our shares being bought back and accounted for in 2025. After deducting both the cash dividend and this last share buyback, are very strong, 17.9% headroom towards the expected and required level by the FSA. So a positive backdrop, a strong capital supporting our ability to continue to grow, and a commitment to deliver on our dividend policy, as we demonstrate again by lifting the nominal level of dividend from what was distributed in 2024. And from there, we'll take your questions.
Thank you. Operator, we are ready for questions.
Thank you. If you'd like to make a contribution on today's call, please press star 1 on your telephone keypad. To withdraw your question, please press star 2. You will be advised your question. We will take our first question from Gulnara Saikulawa, Morgan Stanley. Your line is open. Please go ahead.
Hi, good afternoon. Thank you for taking my questions. I have two, please. First one on competition. Can you share your current observations on the competitive dynamics in Norway? That you are seeing any meaningful changes compared with the last year? Lending spreads have come down this quarter. At what level do you expect them to normalize, and how to the competitive environment, and what initiatives can help you to offset the pressure on margins? And maybe you can elaborate more broadly. Are competitors' pricing actions, or do you see digital capabilities and service quality as the primary levers to retain customer flow?
Thank you for these questions. In general, on the competitive environment in Norway, we qualify that as strong. I think we have seen and we have said for some quarters that capacity and appetite to grow is larger than that of the demand. Our focus on growth is always profitability. That is why we're also pleased to say that even in this environment, we are able to deliver profitable growth across all sectors. The strongest contributor in being corporate customers Norway and large corporates. And on large corporates, we are, of course, also leveraging our platform to grow outside of Norway, and half in the quarter and for the year stems from our activities outside of Norway. And again, we often talk about this platform and our ability to leverage decisions, and this is typically a year where you see that being demonstrated. We always advise you to look at the volume-weighted margins, individual spreads, in particular in periods where the key policy rates and prices are moving, and therefore a decrease of 6 basis points in the fourth quarter. This represents materially the impact of the repricing implemented throughout the quarter. It does also represent, in part, mix change, different growth between lending and deposit, margin pressure related to the competition we have talked about. We are, I would say, offsetting margin, leveraging our platform, our presence, our capability across Norway to grow also in times of strong. We would not match any price point. There is no need to match any price point as long as we can grow profitably. And we are working, we have talked about, to reduce time to pay out on mortgages. We have reduced the time for mortgage application and processes by % during 25. This is important to customers. We have facilitated much easier registration of businesses for new companies and onboarding into them, and reduced the timing of this by 37%. And of course, we actively use our distribution, both digital and physical, in order to market and proactively seek growth. So this will be our strategy going forward. We do not guide on margins as such. I did mention that we do expect to see another cut in the key policy rate towards the summer. And this is likely to have an effect if banks continue to also change prices when key policy rates are priced. But we're confident in our time deliver growth and reiterate the ambition to grow 3 to 4% for the group. It's not the max. We did grow by 4.9%. And as long as growth is profitable, there is some flex to this, but the main plan and sort of ambition is a 3 to 4% rhythm, I would say, on the back of the platforms that we command.
Thank you. Very clear. And just the second question, the impacts on NII. How should we think about this item going forward, and what are the key underlying drivers for other NII? And should we assume for the that this benefit is non-recurring?
Well, it's a harder element to give you sort of guiding on in relation to other elements related to and margins, because other NII tends to be more volatile from quarter to quarter. It's a bucket consisting of many different. If you look at the previous a negative delta from quarter to quarter, this quarter we are in a situation where all of these major elements, they come into positive. Among the categories that are represented in other NII is interest-bearing activity that is not directly linked to lending, and some of the examples being securities finance, another being short-term management of liquidity. It is also a bucket where that stems from intercompany elimination in the accounting will be visible, and it also bears elements of non-performing portfolio that can impact the numbers from quarter to quarter. So there's no real sort of ground rule for indicating the direction or which level it should be at. If you do, however, look at this over a longer period of time, I think you would often than not, there is a stronger contribution in the fourth quarter than in other quarters.
Thank you very much. Very clear.
Next question from Sophie Peterson, Goldman Sachs. Your line is open. Please go ahead.
Yeah, thanks a lot. Here is Sophie from Goldman Sachs. So the fees, the investment banking fees were very impressive, up 100%, over 100% year on year, and over 60% quarter on quarter. If you think about the sustainability of this fee income line, is it fair to assume that it could be kind of a normalized Q4 level, or should we expect kind of the level we saw this quarter to be a normalized level? And then my second question be on the Polish mortgage provisions. Could you please just remind us what the outstanding exposure is, any additional provisions this quarter for that book, and how much the total provisioning or coverage is? Thank you.
Should I start?
Yes.
Hi, Sophie. It's Alex here. So referring to the investment banking fees and the growth that you mentioned in Q4. Well, first of all, of course, a seasonally strong quarter for investment banking normally, and we saw that also this year. But I would say that the activity level is broad-based, and while we also had some large significant transactions, it was broad-based enough to say that we expect that to be a sort of normalized level for Q4.
Yes, and when it comes to the Polish portfolio, this is 34 million NOK, which is much lower than last quarter, but this is what we see sufficient for the situation. Currently, the size of the portfolio is 2.4 billion Norwegian kroner, which where the composition is 89% in euro, 1% in Swiss francs, and 10% in zloty denominated.
And sorry, just a clarification on the Polish portfolio. What was the original exposure of this book?
The max exposure back in time?
Yes.
I don't think we have that number.
Okay.
But yeah, I'm not sure why that would be relevant. I mean, what we're outlining now is the current exposure and spread across currencies.
Okay, no, because some of the other European banks with Polish exposures are saying, I mean, if you look at the Polish banks, they have like 6% coverage because they are saying that you basically also can get claims for loans that have already been repaid. So I was just curious that the size of this exposure at the peak was.
Okay. Yeah. So I think what we can say is that the aggregate that we have taken of our best estimate as to the representative level of impairment.
Okay.
We will take our next question from Ricardo Rovira, Mediobanca. Your line is open. Please go ahead.
Thanks everybody, and thanks for taking my questions. A couple, if I may. The first one is, if I remember correctly, and if I understood Kjerstin, you mentioned that in Q4 you somehow experienced some lower margin pressure than if I got your comment right this morning. I was wondering if you could elaborate a little bit on what exactly that meant. And the other question I would you is, if the loan book is supposed to grow kind of 4%, because this is more or less what you have delivered in 2025, this is a fairly elevated number, at least in Western European countries, that the pie is large enough for everyone to have a profitable growth without margin pressure. 4% is fairly high for Western European standards. So I was wondering whether that comment to you makes sense or not. And then, sorry to get back to what Sofia just asked on Poland, but it's not clear to me if you actually charged some provision in this quarter related to the Polish portfolio, and how much that was. Thank you.
Thank you, Ricardo. We charged another 34 million this quarter. You are correct. I did mention an observation that we had seen lower margin pressure in Q4 than Q3. I would qualify this as a comment related to the fact that we are not seeing spiraling and rapidly increasing rather than indicating what we expect to see in the future. My reference was also pointing to the fact that it's not just thinking about growth versus pricing. I'm quite happy to see the work that Maria and her team is doing in order to leverage our position, our products, channels, both in terms of physical distribution and digital, in order to generate new customers and across the services and products we are offering. 3 to 4% growth has been sort of our marching rhythm, so to say, above, some years slightly below. It speaks to our growth platform more than to the pace of economic in Western Europe. And you know that we have more of a challenger position in other Nordic countries than means that we are not as dependent on the growth in the economy overall, and we feel that our offering and capabilities towards clients is much improved wording Carnegie across investment banking as well as wealth management, and this is well received by our customers. Beyond that, we continue brand and offering across energy, across the maritime sector, across healthcare, and these are all industries that are driven by some of them we see evolving. And this is the reason why we think we can detach a little bit and deliver profitable. If this means that everyone can deliver profitable growth, I'll leave it up to others to judge. But I think we have highlighted, as we believe it's a fact, that our growth platform is a competitive advantage that gives us room and flexibility that others may or may not have.
Okay, just still, 3 to 4%, it would be at least for Norway less than the nominal GDP. Why should that be the case? Because the inflation is 3, real GDP growth expected to be 1.5, kind of, is one of your slides, if I'm not mistaken, and 4.5. Why the largest bank in the country should be growing less than the nominal GDP?
Well, I think you can order of development of house prices and refinancing activity that fluctuates, and I think and look at the historic development, it has not been very representative to just combine GDP as inflation. I mean, there are other factors that are impacting it. You need to look at credit demand for one. This has come down. The demand, for example, among corporate customers Norway in the SME sector grew by 2.9% year. We are growing more or less exactly in that rhythm. If home construction, as an example, does pick up, we don't materialize in 26, maybe towards the end and into 27. We wouldn't expect it to materially impact the GDP growth, but we would expect our growth numbers. So it's a little bit different than just combining the inflation and GDP. And again, the international platform and the rapid turnover we have in the portfolio, meaning that if you took the gross amount, I think if we were only looking to add volume, we could add much more. But we are very focused on profitability, and the larger the clients, the larger the holdings, we'll also look to syndicate, originate, and distribute. So the gross level of business that we're doing, which involves also a lot of refinancing commitments, is again much higher than the GDP growth.
Fair enough. Thank you.
As a reminder, if you'd like to ask a question, please press star 1 on your telephone keypad now. We will take our next question from Jacob Kruse of Open. Please go ahead.
So 2 questions. Ask on Carnegie. What would be you found greater success than you had expected in your plan, and conversely other areas where challenges? And second, just to understand, when we look at this other effect and thinking about 2020, 2026, and I guess Q1, think it makes more sense to start at the Q3 as a base level, or is Q4 kind of a better starting point? I realize that if you could elaborate on that. Thank you.
Thank you, Jakob. I'll hand it over to Alex to answer Carnegie. On the other NII, I'm afraid I won't be able to give you much assistance. You will see that it is a line that fluctuates. I would just reiterate, not having gone back and looked at this quarter, but over time, if you look at several years, it tends to be a lower contribution in first quarter, the fourth quarter, typically because of more element also towards the end of the year. You need to keep in mind a non-recurring quarter number of 100 million.
Yeah. Hi, Jacob. It's Alex here. So your first question, what sort of areas have we had greater successes than we maybe at the outset? And I'd say we to this believing that the two business great fit in terms of and that all integration time consuming, and maybe start by highlighting that we are all only really 2 full quarters in combined operations in. So if we go May of last year, really the focus point has been to bring the organizations together and bring our combined products to our clients and really get position. And then if I were to summarize them both Q4 and 25 in that context, we have made very good progress on market position. The areas that are most affected in a sense by change is in equities and in investment banking. In equities, very, very clear market leader in the Nordic region, and we do see that the scale will result in more efficient and more attractive offer to our clients. I think at the moment we are ranked number 1 in 3 of the 4 Nordic countries. And really see that the two organizations really complement. I've mentioned before from have a DNA in DCM that Carnegie didn't have, and Carnegie have a strong DNA in ECM that we've, for instance, spent in the fourth quarter where Sweden was an active IPO market. So altogether, we are, I think, very, very happy in where we've gotten and the client feedback that we are receiving. And then highlight then that it's still early days, and we believe the better opportunity of us. Maybe following up on that, Harald, the work together with LCI has been progressing well the year, but I really feel that that's accelerating at the moment. And in terms of challenges, I think it is a significant amount of work to bring two organizations together, and that process is very much ongoing, but I think we're making good progress.
Okay, thank you so much.
We will take our next question from Ricardo Rovere, Mediobanca. Your line is.
No, thanks for taking my couple of follow-ups, if I may. The first one is on something that I always ask you, and I always forget the answer, is on the Solvency II ratio is again 260, around 260%. It was supposed to come down, but it always remains 260. Wondering, what is the level that you target over the medium term, not 10 years? And is it supposed to be upstreamed, in a faster way, the capital that is generated in insurance operations? The second question is on SRT. Just an idea if you have been active, what you have done, if it's an instrument you are actually using at the moment, you have been using in the past, just a little bit. And then maybe just a curiosity, given the 171 million NOK one-off in NII, I was wondering what this refers to. Just a curiosity.
Thank you, Ricardo. I will hand the SRT question over to Rasmus, but I'll briefly respond to DNB Liv. We haven't specified a target specifically for solvency. We have said that if solvency ratio is above 140, we will distribute up to 100% of the annual results as dividend. We are very pleased that DNB Liv has managed to quite substantial volatility in the solvency ratio towards rate changes. So it's vastly more robust than it was. We had a strong result there from Liv, pre-tax profit of 1 billion for the fourth quarter, and of course the solvency of 2.6 will upstream the 100. We are likely to upstream 100% of the results in dividend. In addition to that, that we are in a process where we are capital up to the parent, which strengthens our core equity tier 1 ratio and our ability again to pay dividend to our. And that amount, I think it was for the third time that we did this the fourth quarter last year, now 1.5 billion. You are asking the question, could we do this faster? I told you on the Capital Markets Days that we look to upstream 10 billion. 30 billion, sorry, in the 10-year period. I think that still stands firm. This is a process where we need approval from the FSA when we pay more than 100% of the result, really to do this sustainably in a gradual manner that enables us to continue. But I think you're clearly seeing our intention, and that is to excess capital, and we are now in a situation where the guaranteed portfolio is gradually diminishing. 171 non-recurring because you can't expect to see it every quarter. It's still real revenue, but it should have been spread out differently across the year. I can tell you, but it's related to real interest income, but you shouldn't expect to see the same kind of quarter.
Yeah.
Okay, but sorry.
Yeah, in terms of significant risk transfer, we have done one large securitization within the transport area, green transport, in the past, and we are looking at further potential in securitization, important areas of the bank going forward. In addition to that, We also had, and as mentioned during this morning's call or presentation, insurance actively to strengthen our originate and distribute on the large corporate side, which this year also became visible on our transfer and banking fees area. So in terms of SRTs, both on the securitization and on the insurance side.
Rasmus, there would be more room to offload to reduce capital absorption on the back of these, or you think you are doing what you can do?
We believe there is more potential within securitization, and we are further pursuing that.
Right. Very clear. Thank you.
We will take our next question from Sri Srivastawa, Citigroup. Your line is open. Please go ahead.
Hi, and thank you very much for taking my questions. The first is the 200 million non-recurring costs that you saw in the quarter. Could you be a little bit more specific about what these relate to? Is it sort of variable or something else? And the second one is, can you provide a bit more color on the growth, particularly in corporate customers Norway? Specifically, what sort of underlying and what might be shorter term, for example, bridging facility, something like that would be very much appreciated. Thank you.
Thank you. I'll do the question, and I'll hand the question on cost to Rasmus. If we look at the growth for the year, because I think that makes more, the growth in corporate customers Norway was 5.2%. Important to highlight that commercial real estate is also part of corporate customers Norway, as our regional business with SMEs. And of course, they differ when it comes to pattern and growth. I think what is important for us with SMEs is to continue to see profit. For the year, we see a credit growth demand of 2.9%, and our growth is 2.8% in the SME area throughout the year. And we're pleased also to see that a higher number of customers are choosing us as their bank, and we have a material uptick in terms of new customers selecting DNB. This also means that the larger part of the growth, or approximately half of the growth, come in commercial real estate. Several large transactions was closed in the fourth quarter. These are transactions that were composed of underwriting elements with a view to syndicate. For the major part, these syndications have already been completed after New Year's, that is towards the end of this year. This is normal for state, so I'm not sure I would qualify it as recurring or non-recurring. We have an attractive book of commercial real estate where we turn the capital around more rapidly than typically see in an SME book. But of course, what this means is that the tailwind that you can see from the quite material growth that came in towards the end is not necessarily sort of lasting through the first quarter, as we are distributing material amounts into the market.
Very good. In terms of the one-off effects on costs, there's 200 million, as you pointed to. 50 million of those are attributed to the integration called DNB Carnegie. There's also year-end events relating to and effects relating to variable salaries that have been throughout the year and then ending up in the last quarter, and other operational expenses.
Understood. Thank you.
Thanks.
We will take our next question from Thomas Svensson, SEB. Your line is open. Please go ahead.
Yes. Hello. Good. A question to the buyback program. You now point to the fact that you buy back 2.5%, including the today's announced program. So, how realistic is it to sort of manage to execute about 2.5% per year on this program from a or a total shareholder point of view?
Well, I think what we can see now is that we are looking to deliver on this and a half. In terms of going forward, this depends on the total volumes and many variables, so it's hard to describe in the future years where it is. But for 20, this is what we are able to deliver.
But I think we can add that we've said all along what asks the General Assembly of share buybacks. It's indication for the. I think we've also been we do dual buybacks volume transacted in the market, not as to interfere with the development of the shares. So at some point there is a practical limit, and as you know, we are now smaller pieces where we